So when we take these coins that are, owned by or originated by, corporations like the JP Morgan one or whatever it was, does that present a problem down the road for, this decentralization of currency?
Well, I've always, that's the question that I've always wondered what the long-term prospects are for stable coins if central banks start to issue digital currency themselves. Like right now, stable coins are filling a void and a need to have a stable form of exchange digitally, right? And so, you know, uh, once central banks decide that they're going to get into the digital currency um, game, then there's a real question as to
Buddy, today we have Gary. How do I pronunciate that, Gary?
Melnyk.
Melnyk, Gary Melnyk, and he is an expert in blockchain, cryptocurrency, decentralized finance, NFTs, and something I'm not familiar with a lot of it, but the CBDC, I don't know anything about, and I don't really know much in comparison to this guy. So, welcome to the show. Thank you for coming, Gary.
Thanks very much for having me, Greg. It's a pleasure to be here.
Yeah, yeah, likewise. So where should we start? I'd love to know a bit more about Gary and, where you come from and what you're doing these days. And, we'll
All
go from.
right. Give you a kind of a 5 cent piece on myself here. As it relates to business, a commercial banker with one of the big five banks for more than 20 years. Most of that time spent in commercial banking. So
Right.
was a commercial lender and dealt with, commercial clientele with borrowing needs and, pretty, a lot of experience with financial statements and, getting involved with discussions on markets and management capabilities and materials and of course money. So
Yeah.
that's my background. I left my employment with one of those big five banks back in 2017 because I got a call from a client and they said, look, me and this is a high tech client, me and a couple of guys are we're interested in getting involved in some early startups in the blockchain space. And I'm like, well, what the heck is blockchain? I'd never heard of it before. And
Yeah.
he he said, well, he goes, yeah, not a lot of people have, but he goes, I'm sure you've heard of cryptocurrencies. And I said, oh, okay, yeah, I've heard of cryptocurrencies. I said, those are all scams. And he's like, well, yeah, there's probably quite a few scams out there, but he said the technology behind cryptocurrency being blockchain, he said, we don't feel like that's a scam, that there is a commercial viability for the technology. And so I said, well, I've been with this bank for 20 plus years. Don't think I'm going to make this decision lightly. So give me some time and I'll do research. And so, I started down that rabbit hole and very quickly determined, like, I think this guy's right. I think that blockchain, was, technology that is going to move. Initially I thought the internet forward. That's kind of how I looked at it, that this was like the next step in the evolution of the internet. In a lot of ways it still is, but it's kind of grown
Right.
in my a lot bigger than just the internet, right? And so, and we'll get into that when we discuss some of the various topics. But
Mhm.
so, anyways, I said to him, I said, you know what? I said, if there's a time I'm going to make a move, I was in my late 40s, and I was looking for maybe a different challenge. I said, you know what? Let's give it a try. So, anyways, that's what set me down this path. And then, we we set out to, we're very small, not a large venture capital fund with dealing with hundreds of millions of dollars. We were, kind of in the millions of dollars range.
Hey man, that's
And
yeah, that's
yeah,
something.
well, at the time, I guess it might have been just because it was, 2017, not a lot of people even understood the space. And so we made some contacts with the Blockchain Research Institute, which is in Toronto, by the way. Toronto is actually a huge blockchain hub.
Right.
As,
Okay.
as we discuss some of the content that we're going to discuss today, the world's second largest cryptocurrency slash blockchain was developed in Toronto. So
Really?
yeah, it
Oh, I didn't
was. So
know that.
yeah, so we developed some contacts, and then got introduced to some people that were involved with developing blockchain technology. And our specific interest at the time was supply chain management. We thought that's where there was going to be a lot of opportunity to implement a blockchain solution as it relates to all parts of the of the supply chain,
Right.
um,
Right.
from
Right.
like the production right on through to sale of the product to the customer and so forth. So anyway, so we found a couple of interesting opportunities, and we got involved in those opportunities, and still involved with
Yeah.
one of them. Is but anyway, so that's a little bit about me, and we're
Okay.
so that's my background.
Well, good. Well, thank you very much. I'm glad that you moved on and took on something a little more risky and challenged yourself because that's one of the life's toughest things to do, you know? So good for you.
You're right. It was a challenge to
Yeah.
make that decision. You get a lot of security working for a
Oh,
bank, right?
yeah.
Guaranteed your paycheck and at the end of the 2 week period. So yeah, no, it was different for me for sure. Yeah.
Yeah, it would have been absolutely. So blockchain. So let's start there, and I want to kind of go back to what you were talking about. So how does blockchain apply to the supply chain, and how can that be used as a tool? Before we get into like what exactly it is, I kind of want to pick your brain on that.
Yeah. Okay, so blockchain is basically a database, right? And so, but the difference between the database that you're currently, that people or that companies or that we commonly think of it as a database as a centralized server somewhere that holds data and information, and you can interact with that, but it all goes back to the same server, if you will. And it's not, there's not really, there's not a lot of good security around a centralized server. I
Okay.
mean, recent example I can give you is when the trucker convoy was going on up in Ottawa. The donations website Give Send Go got hacked, and everyone's personal information who donated to the trucker convoy was released publicly, right? And so that was the result of somebody being able to attack a specific centralized location,
Mhm.
and be able to extract data that otherwise they weren't entitled to have, right? So when it comes to blockchain, and to answer your question specifically about supply management, it comes down to trust, right? And cryptographically secured information. Okay, so before I get into an explanation of the trust factors and the cryptographic factors,
Yeah.
um, when it comes to supply chain, you have so many different parts of the supply chain, right? And you're in the metals business, so I can try to use an example from.
Perfect.
I'm not an expert in the metals business, but for example, you got an exploration company. You're talking the very first stages of production of metal. You got to find it, right? So you got exploration companies, and they're out there. They're doing their drilling. They're pulling out drill cores. They're analyzing the cores for materials that they're exploring for. And the blockchain, because it's, again, and we haven't talked about how this occurs, but you're going to have to take my word for it till we get into it, is the trust factor that what's inputted in the blockchain is going to not change, right? It's going to be consistent and it can't be changed. And so, like they take the assay results and they put it into the blockchain and they put all that data in there, and it's been verified by a qualified geologist and whatever the case might be.
Mm-hmm.
And then it goes on to the next stage. Say a major mining company, said, okay, yeah, there's, you guys have found something here, and we're interested in acquiring, this mineral claim or property, whatever you want to call it. And so, give us all your data. So then, they get access to the blockchain where it's stored, and they can be comfortable knowing that this is the data that came out of the ground because it's got the trust factor of the blockchain behind it. So then, the next phase is, the company's going to start digging. And if it's an open pit mine, let's say, they're going to take the tonnage out, and there's X amount of mineral per ton, whether it be nickel, whether it be gold, whether it be whatever the mineral is, and you can actually then take that that material that's been dug up, and once it's put on a big truck and it's being sent to the to the leach pit or however they're going to extract the minerals, that becomes and then so when they extract the minerals, then they know exactly how much came from that particular dig, if you will, and it was put onto this particular truck and it was dumped into this particular leach pit. And so and again, it all comes down to trust, that none of this information can be changed once it's entered into the blockchain. So then after the minerals have been extracted from the the rock or whatever, and then you got to go to the next phase, which you're going to do some type of production or sale maybe at that point. Again, I'm not an expert in the metals market, but and so whoever becomes the next leg of the transaction or the process in the supply chain, gets let in on all the blockchain information, and then ancillary services can be brought in, like trucking companies and shipping companies and customs, and and everything kind of flows through the blockchain, and it's all done with QR codes, right? So like let's say the trucking company picks up like the raw material that's going to be sent to a smelter somewhere that's bought this material because they're going to produce whatever they're going to produce. It's all done by QR codes, and once the trucking company picks up the load, the QR code is swiped, and then the payment is automatically then directed towards the mining company that produced the material, and onwards to the manufacturer, and then it gets QR coded there, and all this blockchain information has traveled with that particular delivery. Okay. And so then it goes to the manufacturer, and then the manufacturer is going to produce whatever their steel, let's say a steel girder of some type, and that's all done and recorded through the blockchain, and then it's onward delivery to the customer, and at every step of the process, once this QR code is enabled, then it triggers the payments, or it triggers a customs clearance, or it triggers whatever's next in the process. So anyways, that kind of gives you and again, I'm not an expert in the metals market, so but hopefully that gives you an understanding of the supply chain and the interaction of blockchain and how it can be utilized to. Yeah. And I other examples out there, like Walmart, for example, has blockchain experiment, if you will, with the beef delivery. So right from the farmer that's raising the cattle, right from the feed that the farmer is feeding the cattle, everything is on the blockchain. And then it goes right up to the point where the consumer actually purchases the package, scans it at the checkout, and the blockchain is updated saying, wow, this package is now been sent to the final consumer. So yeah, though this is there is some use cases right now being developed, like real life.
Yeah, that's really interesting. So if I'm buying that package of beef, like I can pull my phone up and look up the process and everything it's been through. Is that correct?
100% correct. So I mean that product has been tracked. So if you want to ensure that like if the beef is saying it's no antibiotics used, you can scan the code, and it'll take you right from the point that the farmer you know and whatever inputs were used to grow the cow or yeah. So that is all available on the
Right.
blockchain, and you can trust it because, as we'll get into a little bit more detail as to why you can trust that
Well,
information.
that was one of my next questions was, I mean, garbage in, garbage out. So how do I know that the individual is putting in the correct information? Is their name attached to that information? And and in addition to that, I'm just going to say it so I don't forget it. How do we add to that blockchain? I mean, not add. Is it another block that you have to add to that? For example, that beef information, I want to add to it, I don't know, how it was cut or whatever the supply chains that it went through to get to the store. I mean, yeah. So how do we know let's start with that, the trust factor. How do we know that it's true?
Well, okay. So, I mean, for example, and I just go back to the metals example. And so when you get an assay result, you're going to a qualified assayer who's, got the credentials that produce these results. And I mean, you know, they're responsible, if you will. I mean, obviously, anytime information is included anywhere, I mean, you have to use, some experts, some trusted people in the field, right? So, so right now, like when a company, like a metals company, gets the assay results because they're interested in purchasing these mineral rights, I mean, I guess they're going to do their own verification, but they're going to take that. They're going to start with that information that's been provided to them, and they're going to. I guess that's the starting point of their due diligence. But they can be assured that the information they're getting has not been doctored from the original information that was produced from those assay results,
Okay.
right? So I mean, just like anything human, right? I mean, yeah, you're right. You got to have good information. The beef example, I mean, if the farmer is going to use antibiotics and, doesn't disclose that, I mean, I don't know. I guess, you would have to certify these farmers, right? Like whoever you're doing business with, I mean, you're going to go and do your own due diligence. Like Walmart's going to go and, or maybe not Walmart, but whoever's buying the beef from the farmer, because they're making the claim that that these are antibiotic free animals, that they're going to do their due diligence to stand behind that, right? So
Yeah.
there's the blockchain isn't, the purpose isn't to make sure the information is correct. It's to make sure that there's trust that the information that was inputted is correct.
Right. Right. Okay. And it hasn't been tampered with or whatever.
Well, that's the point. Yeah.
Does it also increase the speed of the process? I mean, is it faster, for this whole supply chain?
Well, absolutely. I mean, right now you've got a lot of manual processes, right? I mean, just take a look at payment processing. Especially if you're dealing with international payments, it could take 2 or 3 days sometimes for payment to reach the final destination. And we're going to get into a discussion on the payment solutions that
Yeah.
blockchain and cryptocurrency can provide. But so there's an efficiency that can be highlighted immediately, where with the blockchain and the use of cryptocurrency, you can have immediate settlement, because once that QR code is like, it's almost like a shipper. When you deliver to the shipper, they sign off on the invoice saying,
Yeah.
yes, we received, right? And then that goes to the payment to the accounts payable department, and then they have to input something, and then it goes to the bank, and then the bank has to initiate a wire transfer, and so that whole process can be streamlined with simply once the delivery occurs, you have a QR code, and it says it's been delivered. And this gets into something called a smart contract, which we're going to get into. That's another aspect of blockchain that we're certainly going to touch on. But so Yeah, the answer to your question is there are some significant efficiencies that can be obtained by implementing blockchain solutions. Yes.
Okay, cool. So how does, okay, so, you know, certainly if you do your research, this isn't true, but they kind of, blockchain and cryptocurrency kind of get lumped together a lot of the time. Is cryptocurrency on the blockchain? Is that how it works? Is that what can you help me understand what the difference is?
Absolutely. So blockchain, the cryptocurrency exists because of blockchain.
Oh,
Okay.
okay.
It's not the blockchain doesn't exist for cryptocurrency because you can have blockchains that don't have cryptocurrencies. And when we're talking about private blockchains, which again, we'll get into, there is no specific cryptocurrency. Like the Walmart example that I was talking about, there is no cryptocurrency attached to that type of system, but it's still a blockchain system, right? So if it weren't for blockchain, you wouldn't have cryptocurrency. So it's kind of the chicken and egg. So the blockchain is the egg, and or maybe it's the chicken. I don't know however you look at it, but again, blockchain had to exist before
Right,
cryptocurrencies,
right,
could,
right.
which is what Bitcoin really did, and they call it the white paper is when a proposal like this is developed. They put out what's called a white paper, which explains, how to develop this blockchain or cryptocurrency or system that you're trying to develop. So, you
Right.
know,
Okay. So a cryptocurrency, now there's different types, right? There's the one you mentioned, Bitcoin, and then there's other ones, yeah? And then what is the difference between them? Is it just like a coding thing or?
okay, so, and I like to say I take credit for developing this, but I watch a lot of Kevin O'Leary. I don't know if you're familiar with him. He's the Dragon's Den guy, and
Yeah.
he was a real skeptic when it came to cryptocurrency 4 or 5 years ago. Yeah, no, it's all a scam. You know, so what he says though is that cryptocurrency is basically software, right? And so depending on the type of cryptocurrencies, and there's a few different types, and we'll touch on that. Like one type of cryptocurrency is a smart chain concept where you can have smart contracts, and these smart contracts drive various types of financial transactions without the need for a trusted third party or intermediary, right? So that's one type of blockchain or cryptocurrency. The other type is like Bitcoin, for example, which is basically Bitcoin is the first, and its value is just basically determined by what somebody's willing to pay for it, right? It doesn't, I mean, you can build off of Bitcoin. I mean, there's been some what they call hard forks, like, for example, another cryptocurrency that is related to Bitcoin is Litecoin, right? And that was developed from a fork of the Bitcoin chain. And so, but more or less, Bitcoin was developed as simply a payment mechanism, right? Wasn't developed to develop. It wasn't developed or wasn't used to be able to build upon, right? It was just going to be just used for transactional based payments, and so the technology would be considered old, if you will, but because it's the first one, and people have come to accept that Bitcoin has value. It has value, right? And so people always ask me, well, how high can it go? I said, well, as high as people are willing to pay for it, right? I mean, it could go to $1 million a coin if that's
Yeah.
what people believe that it's worth, right? So,
Yeah.
but from a functional standpoint, the worth of Bitcoin is not going to be determined like, for example, on Ethereum, where you have the smart contracts and you have economic activity that takes place within these smart contracts. And, like just for example, we can quickly highlight, one type of financial activity that takes place on Ethereum, which,
Yeah.
is NFTs. And people are laughing when they hear about NFTs to say, people are paying $1 million for a Bored Ape Yacht Club ape picture. Like, it's crazy. And I agree that it is crazy,
Yeah.
but but it's not, take away the craziness of what they're paying for these things. The NFT can be utilized for all kinds of other things. For example, the European Central Bank put out a digital bond, right? And it's a $20 million test bond, and it's basically in the form of an NFT. So what the NFT is, just so an NFT stands for non-fungible token, okay? Which is, all the tokens are different. So Bitcoin would be a fungible token because all the Bitcoins are exactly the same.
Okay.
Right? And so this digital bond, though, being an NFT, not all the bond tokens are the same. Like, for example, the denomination, not everybody wants to buy $1 million bond worth of the bond. They only want to buy 100,000. So you got 100,000 denomination, you got a 500,000 denomination, you got a $2 million denomination, but they're all they're all different, but they all relate back to the same bond. Right, and then so that's an NFT because it's a non-fungible token, and then these non-fungible tokens the ownership can be split up. So let's say I buy this non-fungible or this bond. Let's say I buy $1 million face value, and then a year or 2 years later, you say I want to sell 200,000 of that. You can easily sell ownership of that particular NFT at 20%. And so if the face is $1 million and you're selling 20%, somebody buys 20% of that, which is effectively 200,000. And then and this is all done through a smart contract, right? And so then they would get the interest payments on that 20% of the bond, whereas paying the other 80% and get my interest payments based on the 80%. And again, all done without any other persons involved other than me and the buyer. Right. So this is what it really boils down to, is blockchain is going to eliminate a lot of the middle man or middle person, if you will, when it comes to financial transactions.
Okay. So I got a pile of questions already, but I mean, how does that, just to address what you're saying here, how does that affect the banks, and like what are they doing because obviously they're going to be thinking about these things and they want to be profitable still, and they don't want centralized excuse me, they want decentralized finance. So what are they doing to be in the game?
Well, that is one heck of a good question.
Yeah.
So to answer that question, let's take a look at the basic function of a bank, right? And so, for the last 200 years in North America, the Canadian banks, just focus on Canada because that's what I'm familiar with and you're familiar with. I think Bank of Montreal is the oldest bank. It's 205 years old. Up to this point, everything has been done since when the bank started, and 205 years ago up to today. The system has been the same, other than in the mid 70s to early 80s, they went through a digitization process when everything became computerized. But all that did was take the manual processing, like the paper processing, and just convert it to digital, right? And so when you went into the bank, or even it's still true today. I mean, well, before the 70s, when you went into a bank, you deposited $100, and so the bank teller, wrote in your bank book that on such and such a day that you deposited $100, and then in the back end, the bank would then on their general ledger under liabilities say, okay, we have this $100 deposit. It's a liability to the bank. We owe that to the customer. And so so computers came in, and it's the same process, right? It's the same. Instead of having somebody write it into your bank book, you get a statement now, which has a itemized printout of all your deposits and withdrawals, and even your payments now. And it's kind of moved to incorporate that, but it's again still done with the same process where the bank takes in the money, they debit their general ledger, and then that's kind of the way the banking system has been for over 200 years. So now we take a look at blockchain and digital currencies, and I can tell you I know of at least one big five bank that has given an executive the responsibility of digital currencies. So
Yeah.
the banks are I think, understanding that this is coming. This change is going to happen. I mean, if you have again, go back to my early days thinking that this was about the internet. It is about the internet in a way, and that it's the next generation of. And so basically, the internet started out as email back in the 1960s, right? And I know I'm getting a little bit kind of down in the weeds here, but I mean, just to
That's
make
okay.
the point here. And so, and then the internet developed from an email system, and then in the early 90s, you had a graphical user interface come in with Windows 3.1 and Netscape. I don't know if you're familiar with, I mean, I was in university at the time, so I mean, this is all coming out. And I
Yeah.
remember dial up, and then you could hear that buzzing, bang, when you dialed in, right? So, and then it was really slow. Like
Oh my
you
God.
download a picture, and don't ask me what type of picture. This is a family radio show, and it would come down one line at a time. It would take 20 minutes literally to get a picture to come onto your screen.
Yeah.
So and then so look to where we are today. So again, to answer your question, this is the banks are seeing that this is the next. So now we're at a stage where we can actually, instead of transferring data, which was the picture coming down, we can now transfer value,
Oh, okay.
right? Assured that this value hasn't been copied somewhere, right? So if I send you a Bitcoin,
Yeah.
right, that we know that Gary sent Greg a Bitcoin, and the Bitcoin blockchain verified this, and the coin is now in Greg's digital wallet, and so that's the transfer of value, and nobody else can spend that Bitcoin other than Greg, right? Like, whereas if you didn't have a system of blockchain, and again, we haven't discussed the specifics around blockchain, so I don't know if this answer is going to be, kind of understood at this point, but is that when the blockchain confirms the transaction, and this value has been transferred, again, it comes down to the trust factor and the way the blockchain is designed. So anyways, that's really what the banks, I think, are seeing now, is that the value can go digitized. And so when you talk about a central bank decentralized currency, I think the banks are interested in that. I don't think they're worried. Like for example, Pierre Poilievre says that he's going to ban digital currencies. If he becomes prime minister, he won't let the central bank issue a digital currency. But at the same time, he then says he wants Canada to be the blockchain capital of the world. So, I mean, those two statements are not congruent, right? So Pierre's going to have to come around on that. And I think he will. It's because, I mean, Canada can't be left behind, because right now you have Russia and China have already got their digital currencies up and running,
Mm-hmm.
right?
Mm-hmm.
So I would imagine that the United States is very carefully and close. As a matter of fact, I know they have. I mean, they're probably very close to implementing some type of digital currency. And I think when the central banks go to this process, there's going to exist both a cash and a digital system for a little while, right?
Yeah.
Just can't automatically just turn the switch. And I mean, cash is a big part of our lives, right? So, but again, to answer your question, the banks are definitely interested. The banks are. It's going to be a major change for them, because instead of having a bank account, you're going to have a wallet, right? And you're going to have a personal wallet. The bank's going to have a wallet where you can move some of your personal money from your wallet, or you can have a transfer from somebody else into your bank wallet or your personal wallet. Like, it comes down to, would you feel comfortable to having all your money on your phone? Like, it could lose your phone. Your phone could, there could be, it could be damaged and you have no access to it. Anyways, and there's another reason why maybe the banks could be important in this whole process when it comes to privacy, right? Maybe the banks can be the firewall between, because we'll get into a scary discussion about central bank decentralized currencies as it relates to privacy when we get into the central bank CBDC discussion. But the banks could play a role in privacy and in making sure that the bank and the government doesn't know what your transactions are, right? I mean, the government should not know. Like if Greg and I come to an agreement on I'm going to buy your car, that's nothing. That has the government should be of no business of theirs. Or you come over, you're a
Yeah.
plumber, and you got plumbing. I mean, that should be not the business of the government, right? That's a private transaction. So with the digital currency, though, the government could potentially, depending on the policy around how it's designed, could potentially have a significant ability to, snoop into people's private financial affairs. And again, I go back to the trucker convoy. Look what they did with the Emergencies Act, and they froze bank accounts, not even just the truckers that were there, but other people that, donated $50 to the cause, and, their bank account got frozen, right? So,
Well, that
yeah, the government has access to your financial transactions is a bit of a problem.
Well, it's a big fear, absolutely. And, so many people I talk to, people I know, it's like, well, this digital currency, and then if there's no cash, then I have no privacy. And I tend to agree with them. And so that's a big issue for people. They think about it. People aren't
Well,
stupid,
I, you want to hear a scary scenario?
I do. Yeah. I mean, and I hope that you're right, that the banks or somebody can mitigate the openness of all this. And I hope blockchain can do that as well. I don't know. So yeah, let's hear the story.
Well, I mean, yeah, blockchain, I mean, it can be private, but if the central bank designs it in a certain way, I mean, it can be, they can have access to a lot of private information. So let's take a look at the climate emergency, right? And so you got governments that are pushing forward with climate related policy, and they're telling us it's urgent and that we need to act, and we need to cut our carbon use, right? So I can, with blockchain and with with not with blockchain, but with a digital currency, you can program that money. So for example, let's say in the future, 10 years or 5 years from now, the government has a digital currency available to them. And so then they decide, well, we're going to come up with a carbon budget, and everybody's going to have a budget for carbon, right? And so once they hit that carbon budget, they can no longer spend their money on anything that has, carbon related. So for example, if I'm, wanting to take a trip to Hawaii, but my carbon budget has been used because I put gas in my car because I don't have an electric vehicle, then sorry, you can't buy that plane ticket because you'll be going over your carbon budget. And again, this is all done with smartphone technology. It's all done with apps, like we saw with the ArriveCan app. I mean, apparently that app could track your movements, and so it is a plausible thing that the government could potentially utilize this technology to control your personal spending behaviors done under the guise of a climate emergency. And personally, whether you believe a climate emergency exists or not, I just don't want the government to have that type of control over my consumer spending, right? Now,
Yeah.
there's whole other things that could, think, for example, there could become a carbon resale market where the people who are a little lower on the financial totem pole can sell their carbon credits to the elites, to their people who have money, but then they get to participate even less in the carbon society because they've sold their credits, right? So that means they can't put any gas in the car, they can't take a flight to Hawaii, and yet the elites, it doesn't affect them because it's just like another tax. Oh, I'll buy these people's carbon credits and I'll still be able to go and fly to Hawaii. So anyways, that's a bit of a nightmare scenario that
Yeah.
is potentially possible with a central bank decentralized or digital currency. So yeah, I'm hoping that any policy or any design of a central bank digital currency will include some safety from a privacy perspective, and so that this technology can't be used to to infringe upon people's private financial affairs. And I think the banks could potentially play a role in that. So their role from safekeeping money will move from a safekeeping money to safekeeping people with money from the government, right?
Well, that's good. That's good. That's optimistic. I hope so.
Yeah.
Yeah, I mean, and anybody listening thinking, oh, that's crazy, that could never happen. Well, it's already happening in places like China, for example. They have a token system, where you're allocated this much for said things. So,
It's
uh,
a simple credit system that they have, and basically you get a score, like a credit score, like like when you apply for a loan, you got a credit score here in Canada, right? Well, in China, you have a social credit score, which determines whether you can actually, qualify for that loan. If your social credit score is too low, you can't qualify for the loan, or you can't qualify to, travel. You can't. I mean, again, yeah, no, you're right. These systems already exist, and I mean, it's not. I'm not a conspiracy theorist in any shape, way, or form. But when I see that, the potential is there, I'm going to certainly call it out and say, hey, listen, this could happen.
yeah, I
Right?
mean, we're also hypersensitive to that conspiracy theory thing right now because there's been so much information in the past 2.5, 3 years, right? But there's some truth in all of it. Not all of it, excuse me. There's some truth in some of it.
Well, I mean, what seemed to be a conspiracy theory, a year ago is now fact, right? And in some cases, so I mean, it's yeah. I mean, like I said, I'm not a conspiracy theorist in general, but certainly I've seen some instances where things that were called a conspiracy theory now are kind of mainstream. Yeah, that's a fact. So
Yeah, absolutely. Well, and I would just say always be questioning everything.
yeah, I mean, there's nothing wrong with questioning, but I think the government doesn't like
Yeah,
that.
I know they don't. So, blockchain, let's get into the specifics. Can you help us with that? The What do we need to know? So, I mean,
Well, okay.
you mentioned ledger, and is there like a digital ledger?
Well, I mean, so blockchain is basically a decentralized ledger technology, right? So, meaning that the ledgers that blockchain creates, so again, remember, it's a database, right? And so this ledger is a database. Um, this this ledger is not stored in a central location. It's
Where is it?
stored
Where is it?
It's stored on, so anybody's participating in the network. So we're going to talk a little bit about, how these networks are secured, and they're secured two different, well, there's more than two ways, but the two main ways are called proof of work and proof of stake. We'll discuss that in more detail. But so the miners or the validators, so miners work in a proof of work environment where they run all these very energy intensive computers and computer programs to solve very complex math equations in order to win the right to confirm a block of information on the blockchain, so a block of transactions, right? So that's proof of work. Proof of stake is a little bit different in the sense that anybody who wants to put some of their cryptocurrency up, like ethereum for example, you can put up 32 ethereum and become a validator, right? Or you can go to an online cryptocurrency exchange like Binance, and you can participate in their program and put some Ethereum into their, because 32 Ethereum would be I think roughly $50,000. So not everybody got $50,000 put into this. So you could still participate at a lower level, but you'd be going through, a third party, which they would charge, a certain percentage, and you get paid like in a proof of stake system, you get paid like an interest rate, like a fee based on, right now currently, like Ethereum is paying out roughly 4.5% on your money, right? And so people that own Ethereum and they want to be validators on the network, so they can put up some Ethereum and be part of that process.
Okay. So that's why they would do that, is so they can get that five or four and a
So
half.
you build exactly,
Okay.
correct.
And then a miner, what would be the reason to be a miner?
Well, so again, you're part of the security of that particular blockchain, right? So Bitcoin is a proof of work system, and so you get paid Bitcoin in to participate in being a miner. So as your compensation for participating as a miner to confirm these transactions is paid out to you in the form of Bitcoin,
Okay.
right? So you'd be accumulating Bitcoin, and of course, then out of that payment of Bitcoin, then you'd have to pay your electricity bill, and you'd have to pay for all the, the equipment that you purchase to become a miner, and so there are expenses to that. But so and just recently, I mean, proof of work is very energy intensive, which is a concern for a lot of people, and
Right.
very Ethereum actually moved from a proof of work system to a proof of stake system, and it reduced the energy consumption by 99.5%. So it was very friendly, environmentally friendly move from one system to the next. And it was done September the 13th or 15th, something like that. And so far it's been working for them. But
Good, good.
so getting back to the original question, is that so on this, on the decentralized ledger, so these ledgers are all kept with all the miners, everyone who participates in the network, right? So if there's 100,000 miners, there's 100,000 copies of the Bitcoin ledger. Okay, so when a transaction occurs, then all these ledgers have to agree that this transaction is a valid transaction, right? And that that Bitcoin that is being proposed to be transferred between Gary and Greg, that it hasn't been already spent before, i.e., the double spending problem, right? So once that can, and then so when I send you the Bitcoin, it goes through a process where it gets confirmations, right? So I think a Bitcoin transaction, I could be wrong, I haven't looked at this in a while, but I think after 12 confirmations, it becomes a valid transaction. But it still goes through the rest of the process where all the ledgers get updated and are in agreement with that particular transaction, right? So again, that relates back to the security. So it's not one central point of attack. So if anybody wanted to attack the Bitcoin chain, they'd have to attack every single 100,000, if that's how many miners are out there, they'd have to attack all of them. And it's highly unlikely anybody would be able to, to infiltrate that. And that's only the first step of security. I mean, as we get into discussion about how, the actual blocks that are created. So like when I do a transaction with Greg and then somebody else does a transaction with Bob and Sally, and there might be 50 transactions in a minute or 10 minutes or however long the time horizon is. And all those transactions get placed into a block. And I think there's a block created every 10 minutes, if I'm not mistaken. I could be wrong about that. But Bitcoin, I think, produces one block every 10 minutes. And then when the block, so this is where the cryptography comes into play, is all those transactions are then translated into a cryptographically. And there's a website you can actually go to this and put in like a sentence, and then it'll actually cryptologically, it'll change that sentence so you can't notice it at a sentence, and then you can put the the output of that cryptological information, and then it'll convert it back to the sentence that you cryptologically encoded. So anyway, it gets into, like, I'm not into the details like that because it gets into the weeds and whatnot, but so the way that the way the blocks are constructed is that you have what's something called a hash. Okay, and the hash, what that is a cryptological representation of all the transactions that took place in that block. And it's the last entry of that block, and it becomes the first entry of the next block. And that's where the chain comes in, right? So that's why they say a block chain. So the hash actually changed the next block to the previous block. And then, so then the next block has that previous block's cryptologically encoded transactions, and then it does its own thing. And after 10 minutes, another block is created, and the hash gets created, which includes the very first hash that was included in the block. So that's what makes it near impossible for somebody to change a transaction once it's done, because if they change one transaction in this block, it changes the hash on every single block that comes after it. And so it's just not logistically possible. And Bitcoin's been running since 2009, and we're into 2000 and almost 2003. So we're talking 14 years, and nobody been able to hack the system. So, and which is really wonderfully designed because it doesn't even run security software. Like it's just a really clever code and a process that was developed that to this point has proven that it cannot be beat.
Wow. Wow. So is Ethereum like a totally different code, or I mean, how does
No, it's all the same. So again, a block is created. I think it's with Ethereum that a block is created every 2 minutes. Although again, I haven't looked at it in a while, but there's a time frame. So and there's a lot more transactions that take place on Ethereum than Bitcoin. I mean, matter of fact, I think Bitcoin only can handle something like 12 transactions a second, and I think Ethereum can actually handle right now about 50 transactions a second. And
okay.
anyways, I mean, there's ways they're going to improve the speed there. But so, yeah, so it's the same. It's a blockchain. So all blockchains have the same characteristics, right? So you have a block, you have all the transactions in the block, and then you have a footer with the hash, which is cryptologically encoded, and it goes and it becomes the first entry in the next block, and then in 2 minutes time you accumulate however many transactions occur, and then you put the footer again. It's called the hash, and you cryptologically move that over into the next block. So yeah, so Ethereum is the exact same process, but now instead of being proof of work where the miners are validating, because again, everybody who's on the Ethereum network that participates has a copy of the ledger, right? And it's the same process that, there's a, when you do an Ethereum transaction, there's going to be, until it becomes a valid transaction, there's going to be so many, confirmations that this is a valid transaction, right? So it's exactly the same process, but done under a proof of stake where people who basically own the chain, like you're owning Ethereum, so you own part of the chain. You validate now as part of the ownership of the chain.
Right. Okay. So correct me if I'm wrong. Okay. So Ethereum is a non-fungible token. Yes.
No, Ethereum is a fungible token. They're all the same,
They're all the
but
same.
you can mint non-fungible tokens on Ethereum, which is
Oh,
a way it separates itself from Bitcoin because you can't develop those. So with Ethereum, you can build on the Ethereum chain, and you can build decentralized finance applications. You can build NFTs. You can build lots of other things that are not. And again, it all comes down to the ability for smart contracts to operate on the chain, which is very different than Bitcoin, again, being a payment system as opposed to a financial transaction system.
okay. Well, let's not forget to talk about smart contracts, but I got a question. Okay, so if I'm transferring funds over a border, which I assume is a great way to use these digital currencies, why would I choose Ethereum over Bitcoin or vice versa?
Um, well, I would suggest you'd probably choose neither, but I mean,
Oh,
just to get
really?
because I mean, Ethereum, again, it's not a payment system. It's a smart contract system. So although you can send Ethereum, right? I think if I have some Ether in my wallet, and you're living in Sweden, I can send to you, Ethereum into your crypto wallet, right? So it can be done. Bitcoin, again, it's not efficient, right? Because you can only do 12 transactions a second. And
Okay.
I mean, when crypto markets are going up, I find that the transactions take a lot longer to transact. I mean, I remember in 2017 when I first got into this, and after I did my due diligence, I immediately went and bought some Bitcoin at, like, I don't know, $4,000 a coin. Now the sad story is I sold it way too early, but anyways. um, so there is another coin or cryptocurrency, if you will, another blockchain that really does specifically address the question that you had is about international payments, and that's developed by a company. Now, this is a little bit different than than Bitcoin and Ethereum, which is a community based. So basically, this has been developed by a community, whereas Ripple has developed a cryptocurrency called XRP, and Ripple is a company. Okay, but what Ripple is doing is they are attempting to replace the SWIFT banking system. Now, I don't know if are you familiar with the SWIFT banking system?
Well, I am, but can you explain it for anybody listening, please?
Yeah. So basically, right now, when you send money internationally, the bank that you're dealing with. So let's use Bank of Montreal for example. If I go into the Bank of Montreal and I say I want to send $100 to Greg, and he's in Africa or he's in somewhere in Europe, and they'll say okay, fine. So they take your $100, and then once they take their fees, and other banks take their fees. Greg only gets $70, but that's a different issue. So the process is the bank will then have to go to what's called a correspondent bank in whatever country that you want to send that money to. So the banks all have relationships in all these different companies with these different banks to facilitate these international transfers. So then what they do is, if they have a correspondent bank, they send almost like a memo, right, to this bank. It's all done digitally, but it goes to the bank saying, okay, we have $100, and it's going to not your bank, but a bank in your country. But you're our correspondent bank, so you need to take that money in. And then once you get the money, we want you to send it over to the other bank in your country, which we don't have a correspondent banking relationship with. And so it could take 2 or 3 days before Greg ends up getting his money. The other problem with that system is that the banks have tied up billions of dollars in capital in deposits with these correspondent banks because, again, we live in a world without trust, right? So the correspondent bank wants to ensure that the Bank of Montreal is going to make good on sending that money over, right, before they send the money to the correspondent bank. So the way the banks do it is they say, okay, well, let's open up a deposit account with your bank, and we'll deposit $10 million or however much of our transactional volume is daily. We'll have that on deposit at your bank, right? So that you guys can feel comfortable that we're going to, that you're not going to be stiff with, having sent that money to Greg and we end up not getting that money to you. So that ties up a huge amount of capital, which could be otherwise deployed in, some, more efficient way, and in a way that could produce a better return, because I'm quite certain that those bank accounts aren't generating a lot of interest, at least not as much as that could be used if that money was repatriated somehow if a digital system was in place. So for example, with Ripple and their XRP coin, to send money to a person, and you wouldn't even need the bank technically, right? Is that all I would need is your digital wallet. But let's just assume you're not technologically savvy and you don't have a digital wallet. So the bank is going to do this transaction, but they're going to use XRP. It's very simple. That memo they send digitally, they can now attach. Just like attaching an attachment to an email, they'll attach the digital currency to that email. So that money comes over with the email, and so now there's no need to have those deposits in the correspondent bank's institution in their bank account. So that's another benefit. So it's not only just speed of transaction, it's repatriation of capital that the banks would be very interested if a system can be developed. And XRP is well on its way to having this system in place. The other thing that XRP does is there's a trade finance solutions where right now, that if you're a company and you're wanting to transact with another company, say in South America or whatever the case might be, usually you have to get a letter of credit from your bank, right? And so basically, that's the bank saying, okay, well, if so and so doesn't pay you, we will. However, here's some conditions. We want somebody to confirm once the product gets on the shipping container on the ship, right? And so now you got to physically send somebody down to the port, confirm yes, the product was put in the shipping container on the ship, and then now the letter of credit will pay out X amount of dollar, 50% of the value, whatever is negotiated. And so again, if you had a digital system, you can get rid of the letters of credits and simply say, look, we're going to guarantee payment, and instead of using a letter of credit, we're going to use digital currency. So when that shipment hit, or when that product hits the ship, we're going to be able to automatically send you this digital currency. Right? Nobody's going to have to hold that in trust. We don't need correspondent banks. So that's the other thing is the trade finance. And I think the last I looked, there was $19 trillion worth of trade that happens in the world every year. So it's a huge market. And if Ripple is successful in becoming this new way in replacing the SWIFT system, it's cryptocurrency. And again, this is where the value in cryptocurrency comes in. Is it's all about utility, right? How useful is that currency, and what real world problems does it solve, right? So if the Ripple is successful, then I'm going to suggest that XRP is going to be worth a lot more than it is today.
Okay. All right.
Yeah.
Awesome. So, okay. So then let's say that works out great. I'm in another country, and how do you determine, let's say I need some native cash, right? Like I'm in, I don't know, Australia or something, and I need cash. So they send that over, and then that is turned into the equivalent in that cash, right? Based on the market, what the market says. Is that correct?
Well, that's a little bit of a challenge right now for digital transfers. Is that, and let's stick with the XRP example. Is that, if Greg's in Australia and Gary says, "Okay, Greg, I'll send you, $100 USD worth of XRP," and then you need to convert that to local currency. That's a bit of a challenge because you don't have digital central bank currencies right now, right? So, what's your options? There's probably, and I haven't checked that for Australia, but for example, there's something called stable coins, right? And
Okay.
I don't know if you want to get into that discussion right now, but it basically is a cryptocurrency that is denominated in local country currencies like US dollars and even the UK pound. There's a equivalent, and most of these stable coins are backed by actual physical cash dollars, right? So for every $1 of stable coin, there's $1 of USD and behind it. And like I said, I plan to get into a bigger discussion on stable coins, but I don't know, did you want to do that now, or do you want to finish up your question
No,
of how to convert to a local currency?
no. I'm interested in hearing, man. If you got time, I do too.
Like I say, this takes us to there's in a lot of different direction, right? But so basically, cryptocurrency has one challenge, and it's volatility, right? For like the price of Bitcoin, it could fluctuate $1,000 in a day, right? And so people, to send. So if I'm going to send you some Bitcoin, well, if it take and this could happen in a minute or 10 minutes or half hour, the price could drastically change. So it's not very stable, and so people are like, okay, well, I don't like that volatility. So what's been developed then is, okay, well, we have cryptocurrency and we call it a stable coin because we'll take in, and the biggest one is called US dollar tether. And so tether meaning it's tied to a US dollar. So for every US dollar tether that's in existence, we have $1 in US physical dollars in our bank account or wherever it's being stored, right? So I can take for example, if you need local currency, I can actually go and if I don't have any of that local currency, I could sell some of my cryptocurrency for a US dollar tether, right? And then I'll have US dollar tether, and I can send that to Greg. And it's because then you can so you'd have to have a relationship with an exchange of some type, and on that exchange you could sell the US dollar tether for US dollar cash, and then the exchange would then send to your bank account the cash, right? So so stable coins. So, and just to kind of back up a bit, the US dollar tether, when I say it's backed 1-to-1 US dollar, it's not entirely true. And this is, not every stable coin is made up the same way. US dollar tether holds some other investments like commercial bank or commercial paper, government bonds. So there's not all cash backing up their tethers. So some people have some concerns around that. The other popular one is the USD coin, USDC, and
Right.
that's developed by a company called Circle and in conjunction with, I believe it's JP Morgan. I'm not entirely sure, but there's one of the big investment banks that are involved with US dollar, USDC as it's called, and also Coinbase, which is a large cryptocurrency exchange. So, and then there's another type, and this one's an interesting type, and I'll just briefly describe it because we're going to talk about it in a lot more detail. But, anyways, it's called DAI, DAI, and it's algorithm. It's got an algorithm that ties it to the U.S. dollar, but it's not backed by U.S. dollars. It's backed by collateral. So basically, it's a lending platform that takes in right now. Well, it takes in crypto collateral, and they've also onboarded some real world collateral, which is really exciting.
Really?
Oh yeah. So, but what happens when you go to this smart, and it's all done by smart contracts. So when you go to, it's called a decentralized autonomous organization, and the name is Maker, which has created this DAI coin, and it's a lending platform. So you can get involved with Maker in regards to, borrowing something called DAI, this stable coin that's tied to the US dollar, by simply putting up collateral of, say, I have some Ethereum, and so they'll lend me, I'll have to put up 150%. So let's say I want to borrow $100 or 100 DAI. I put up $150 worth of Ethereum. That's the minimum margin. I wouldn't suggest you do that because if Ethereum goes down, then they're going to sell your Ethereum on you. But so you want to have a much larger cushion. But without getting into the weeds of explaining all that, because I just really want to answer the question about what DAI is. Again, it's backed by collateral, not U.S. dollars, and it's algorithmically attached to the U.S. dollar. And again, I'm not an expert on that end of things. I don't know how they developed this, but it's been around since 2018, and it's been pretty stable as it relates to the peg during that time. So so that separates itself from the coins, the stable coins that are backed by U.S. dollars. This one's a little bit different in the sense that it's backed by collateral.
Okay, so when we take these coins that are, owned by or originated by, corporations like the JP Morgan one or whatever it was, does that present a problem down the road for, this decentralization of currency?
Well, that's the question that I've always wondered what the long-term prospects are for stable coins if central banks start to issue digital currency themselves. Like right now, stable coins are filling a void and a need to have a stable form of exchange digitally, right? And so, once central banks decide that they're going to get into the digital currency game, then there's a real question as to what are the prospects to have these stable coins continue on in the same format that they currently exist in. I think the answer, and again, I'm speculating. So what happens when you speculate? You're wrong, like 99.9% of the. But I think the stable coin goes the way of the dodo bird once central banks get involved in decentralized currency, because there just won't be a need for it unless for some reason central banks develop their digital currencies on completely private chains where they don't interact with other chains. Then maybe it could act between the digital currency of the central bank and the other parts of of the digital currency world, i.e. the Ethereum chains and the Ripple chains and the XRP. And so there could potentially, if the central banks go the route of private chains, right? Which I don't. I mean, that's again, well, we can save that for the central bank decentralized currency or digital currency. I always call it CBDC. It's digital currency. But yeah, that's whether it's a private chain or not is another question for CBDC. So.
Yeah, yeah. Okay. A few other things that came up. So volatility. Why is it that they're so volatile? I mean, my gut says that it's because there isn't enough information. Is that true? Like what is it? Why are they so volatile? Like these existing cryptocurrencies?
Yeah, I mean, it's a function of a couple of things, I believe. You have to understand what they are is simply like a whole bunch of zeros and ones, right? And there's nothing, and the value, and again, we're going into a value discussion when you're asking about,
Yeah.
the volatility, right? And so, Bitcoin, for example, doesn't have a lot of utility other than being a transactional payment method. And there's no physical Bitcoins. And so when you're buying a Bitcoin, you're buying a bunch of zeros and ones. And, I think the mainstream, like the average person on the street doesn't own any Bitcoin,
Yeah.
right? Because they wouldn't know how to buy it. They don't know, they don't trust the value. They don't know why it's worth this kind of money. So, volatility is really a function of demand, right? So I think you don't have the mass adoption of everyday people. Now, there are some countries like El Salvador has made Bitcoin a legal tender in their
Oh, wow.
country. And yeah, so, and the government is now, owns Bitcoin, and basically you can pay for, whatever you want in Bitcoin. So, I mean, that's going to drive, I guess, some level of mass adoption. But so, I mean, to answer your question, volatility is a function of it not, it's still in its infancy, right? Like, I mean, I look back and I remember the internet in 1994. That's when I first became kind of, aware of the internet. It used to be called the information superhighway. That's what it was invented as back in those days. It wasn't even called the internet. And, I think so in 94, what did we have? I mean, we had, you know, AOL, and we had,
Yeah.
didn't have any online banking. You didn't have any, you didn't have Amazon. You didn't have eBay. You didn't have PayPal. You didn't have nothing like that, right? And then in about 1998, I mean, you had online banking, you had online stock trading, you had Amazon, you had eBay, you had PayPal, and it all happened in a very relatively short period of time. From that picture coming down one line at a time, taking 20 minutes. Now you're trading stocks online, and you're buying and selling, and so this could potentially grow even quicker than it is. I mean, if you use that example of the internet, because I remember in 1994 watching that one line picture come down saying, this is never going to take off. And this is, well, again,
Look,
I started speculating and I was wrong, right? So, I wish I had the same mindset back then as I do on blockchain, because maybe I would have invested in Amazon and bought it at 20 cents, and now it's worth whatever it hit $2,000 a share at one point.
yeah.
Anyways, so again, to answer your question, back to the volatility. Once we get more people, and listen, not all the coins are going to survive. There's over 10,000 cryptocurrencies right now.
What?
Yeah, 10,000.
Crazy.
It is crazy, and I'd say 99.8 or 9% of them will not exist in just like the .com bust, right? I mean, we had all kinds of activity. You had thousands of companies developing a internet sales strategy and online sales. I mean, I remember a lot of grocery outfits, not mainstream grocery outlets, but a lot of people. There was at the time they wanted to start up online grocery shopping websites, and I know there was a big one in Canada. They had a huge warehouse they built just outside of Brampton. Um, and I forgot the name of the company, but it went bust because the model didn't work. And it's funny now because we're just starting to get back into online grocery shopping since the
Oh,
pandemic, right?
yeah.
Like, it's kind of taken off a little bit more. So you go to Walmart now, and there's actually cars parked in the pickup, for your online groceries now. Whereas, I mean, you never saw anybody in the online
No.
pickup before the pandemic. So I think the pandemic changed some mindsets around that. But we're talking 20 plus years later, that what failed in the year 2000 is now kind of becoming viable. So, anyways, it just goes to show you that, even though there's 10,000 cryptocurrencies out there right now, the likelihood of any, like I said, there is probably going to be a handful that come out of this. And I mean, I think if you look at the top 10 right now, there's probably 2 or 3 in the top 10 by crypto market cap that are probably going to survive. And outside of the top 10, there may be a dozen or so that might potentially become one of the staple chains that survives. But there's not going to be 10,000 of them, I can assure you that.
That's for sure. That's ridiculous. I mean,
Yeah.
um, can anybody, well, see, it sounds like anybody can create a cryptocurrency. Is that true? Like, is that,
Oh, especially with Ethereum. Yeah, it's very,
oh,
very. I mean, so again, that it goes down to utility of the chain, and Ethereum is kind of the jack of all trades in that regard. I
okay.
mean, there's different protocols. One is called ERC20, which is for issuing fungible tokens, i.e., all tokens that are the same. And
Mhm.
then there's a ERC. Geez, I had my notes here. I think it's 721, but I could be wrong. But it's another ERC protocol for NFTs, right? So if somebody wanted to create a fungible token, like a cryptocurrency where all the tokens are the same, you just get a smart contract on Ethereum
Yeah.
and you create. And I mean, for example, I talked about Maker a little while ago.
Yeah.
That's an autonomous decentralized organization that's built on Ethereum through ERC20. And so you have Maker coins, and so they trade about $1,000 a coin. And Maker again has developed DAI, which is a stable coin. Again, that's all on the Ethereum chain as well,
Yeah.
right? So yeah, the answer to your question is absolutely anybody can create a cryptocurrency for sure.
How do you spell the die?
DAI.
DAI coins. Okay.
Yeah.
Cool. I'm gonna look into this. Um, so I had a question. Yeah, okay, so fiat currency, right? I mean, we all know that we went off the gold standard, whatever it was. In the US anyway, it was 71. Um, is cryptocurrency a finite thing, or I mean, is it dependent upon the cryptocurrency like Bitcoin? Like there's only a certain amount of Bitcoin, correct? Are they all like that?
Yeah, I mean, Bitcoin is hardwired into it. Again, we're talking about software, right? So every cryptocurrency is a piece of software, or every blockchain, not cryptocurrency, but every blockchain is software. So written right into Bitcoin software is a cap of 21 million. So there'll never be more than 21 million Bitcoins in existence. And right now, the Bitcoin is issued to the miners, right? So every day, more and more Bitcoin becomes, I think there's something like 19 million Bitcoins in existence, and there's another 2 million yet to be mined. And I think they said that all the Bitcoin will be mined in 2140. The year 2140, yeah, Bitcoin will have mined its
Oh,
final. So Bitcoin has a finite cap, I guess, if you will, whereas Ethereum does not. Ethereum, there's no cap. There's about 122 million Ethereum coins in the market right now. It started out at roughly 60 million back in 2014 when they did what's called an initial coin offering, and they raised, money, kind of like, raising money on in the stock market. Well, they raised it in the crypto markets, if you will, and
right.
it actually was interesting that when they did their initial coin offering, they could only accept Bitcoin as being payment. And then they took the Bitcoin and sold it and got cash for it and were able to then move on with their development plans using the cash, right? So, but yeah, so Ethereum, there's no cap. And just recently, Ethereum issuance has gone down drastically because there's no more miners, right? So September the 15th, when they flipped over from proof of work to proof of stake, I think each block before under proof of work, they would pay something around 2.5 Ethereum coins to that block, or that would be the cost of minting that block for the miners. And then now it's down to like, with the proof of stake system they have, like 0.20 of one Ethereum coin. So it's drastically reduced its issuance. And the other factor too, with the people are saying that eventually Ethereum will become deflationary, meaning there'll be less coins over time, is because when you do a transaction on Ethereum, you have to pay a transaction fee, right, in the form of Ethereum. So what used to happen is those transaction fees also went to the miner on top of the fee that was charged for building the block. The transaction fees of all those transactions and there also went to the miner. But then I think about a year ago, they started not going to the miner. They went and got burned, meaning they went into a smart contract that nobody can access. So the coins are effectively burned and off of the market now. So as time goes forward, there's some discussion about that Ethereum coins could potentially, the issuance could be negative because of the that they have for, and the transaction fees are wild. Back like in 2021, when the market was going from $190 per coin for Ethereum to $4,700. Yeah, that's quite an increase. The cost of doing transactions on the chain was astronomical. Like it would cost 400, the equivalent of 400 US dollars to do a $1,000 transaction. Like it was really make a lot of sense. I mean, the fees were out of whack, and so there's some hope that with the proof of stake versus proof of work, and also the burning of the fees, that it's going to have an impact. But right now, the fees are more reasonable because there's not a lot. Well, there actually is a lot of activity, but it's not kind of like a panicked activity where everybody at the same time wants to buy Ethereum, and it's causing a lot of strain. And of course, like supply and demand, when there's more demand for transactions, the price of that transaction goes up, right? It's like simple economics. But but just talking about transactional values, I looked at this the other day when I knew it was going to come on here. I was just curious. Last year, Bitcoin cleared $13 trillion US in transactional value, which is roughly the same amount that Visa did, right? In their payments, they handled 13 trillion US dollars in transactions. Ethereum is a real interesting one because it's significantly lower price than Bitcoin. I mean, Bitcoin is 20,000 a coin, and Ethereum, I think today is around 1,600. And so if you were to adjust, so Ethereum last year did $6 trillion in settlements. But if you were to adjust for the value, it's about 12 and a half times less valuable than Bitcoin. So if you were to equalize, by increasing the Ethereum by 12, you're talking about $70 trillion roughly in transaction value. If the Ethereum price were on par with Bitcoin. So the economic activity on Ethereum is significant. Yeah.
That's a big eye opener. Wow. So I mean, people are using it, and they're doing things with it. So that's good.
It's being used. Institutions are starting to get very on board. Like I said, JP Morgan is involved, and I mean the institutions are. I mean, Tesla, I don't know if they own it still, but they bought Bitcoin a year and a half ago and held it on their balance sheet. I think they might have sold it since, but anyway, it was a large amount, like $1 billion worth. So, but the amount of transactions that are taking place on, and it's not even the amount of transactions, it's the amount of development. Like the developers on Ethereum dwarf any other chain. I mean, I haven't looked at the statistics recently, but development activity is quite significant. So DeFi, NFTs, I mean, that's really driving, the interest in developing on that chain. Yeah.
So what is the interest? Why? I mean, decentralized finance and all of this, is it a product of the times, or is it just a lot of people want to code because it's, I mean, is it a generational thing, or is it a lack of trust? What do you think it is? Like, is there like an overarching theme with all of this?
I mean, as far as development goes,
Well, development and why all of this is emerging now.
yeah, I mean, it's just because we have the capabilities now to do it. I mean, again, go back to the discussion of the evolution of the internet, right? And so you
Makes
couldn't
sense.
have you couldn't have YouTube if you didn't have high speed internet because like
Right.
the picture in 1994 was coming down one line at a time. You certainly couldn't pull up a video. Right. So before YouTube could exist, you needed to have a development occur, such as high speed internet, which I think 1988 or 99 is when cable internet and DSL internet was developed and significantly increased the bandwidth and the speeds, right? So I
Yeah.
think you're looking at a similar type of evolution with cryptocurrencies. You couldn't have Bitcoin, which was the first cryptocurrency, until you had high speed internet, and you had the technology was in place, I guess, if you will. And the other thing I think that happened around the time that Bitcoin was developed is you had the 2008 financial crisis, right, where
Right.
it was bad. I mean, it was so bad that it was at one point, one bank wouldn't deal with another bank because they were worried about insolvency, and the U.S. Treasury Department had to open up what they called the lending window, and basically liquidity was so bad you had some failure. Bear Stearns went bankrupt, and there was another one I can't recall off the top of my head.
Lehman Brothers.
Lehman Brothers. There we
Lehman.
go. Exactly. So you had some huge failures, and you even had some insurers that got bailed out by, the Fed, right? So, you
IG.
know, yeah, that's correct. You got a good memory. You must be younger than me because my memory isn't that good anymore. But
This is what it
so
is. If
yeah,
it's my anniversary, it's not very good.
I can appreciate that. But so you had some financial happenings at the time, right? And you had technology that was kind of developed to the point where you could have something like Bitcoin come out, right? And so that's what happened, right? And so that's to answer your question. I mean, that's kind of how we find ourselves today, 14 years after Bitcoin, now have 10,000 different cryptocurrencies, right? I mean, Bitcoin was the seed, and Ethereum kind of took it in a different direction with this smart contract aspect of a blockchain. So, again, another point of evolution was 2014 when Ethereum was born, right? So,
Yeah. Yeah, absolutely, man. Well, hey, look, I really appreciate your time, Gary, and
oh,
you
Greg,
taught me so much. And I have this note here, smart contracts. We're going to talk about that next time, and I want to get into deep about it. But I think for today, I'm overwhelmed. I got to sit and think. But where can people go, myself included, to learn some things, in the meantime? Do you have
I've got links and stuff I can email to you. I'll email them to you, and yeah, some good information for due diligence or for just personal reference and whatnot. And yeah, I keep these links kind of handy when I'm looking to. If a question comes up that I don't understand, I can pull up some information. So I'll send you some links, and I've got a
Perfect.
couple too that I can send you as well. Actually, there was just one recently put out. I forgot which magazine did, but it was the second time in their history that the magazine, the whole issuance, and it was 100-year-old magazine. The whole issuance was one article, and it was all about cryptocurrency, written by one reporter. So, anyways, I'll send you the link to that. It's actually well
Perfect.
done. It's done from a non-cryptocurrency enthusiast perspective. Like this guy's not a crypto enthusiast, so it's very layman and very easy to understand, and it really gives you some real good foundation for understanding it. So I'll email you a pile of stuff, and then you can maybe do whatever you want with it. And
Perfect.
then whoever might be watching, put up a link or whatever.
Absolutely, I will. Yes. All right, Gary. Gary can be found on LinkedIn. That's where we connected. So if you got deep questions, deeper than mine, reach out to him. So, all right,
We'll
Gary.
try to.
Yeah, well, you will definitely do that, I'm sure.
All
So,
right.
all right, Gary. Thank you so much for your time, and we'll talk
Thank
to you.
you, Greg. To
Have a
take
good
care.
evening. Okay.